So you're a founder, you're building something amazing, and one day you're going to think about your exit. But what if I told you the key to adding millions, literally millions, to your company's valuation isn't some secret growth hack? Nope, it's actually hidden in plain sight, right inside your financials. I know. Accounting doesn't exactly scream sexy, right? But trust me on this one. The way you handle your books is one of the most powerful M&A tools you have. This isn't just about keeping things neat. It's about building a fortress of value. Because when it's time to sell, a clean, well-told financial story proves your company's worth in the only language every buyer speaks. Think about it. This is the first impression, the moment of truth. Before they even get to your amazing product, your incredible team, or your cool brand, they make a snap judgment based on one single document. What do you think it is? Yep, it's all about the story your P&L is telling. This is the main narrative a buyer uses to figure out the health, the efficiency, and ultimately the real value of your business. It tells them if you're a finely tuned machine or a risky gamble. All right, so let's dive right in. We're about to bust a huge myth that the only thing that matters is that big revenue number at the top. The real value, the hidden value, is in the details. And the very first detail a buyer looks for is a sign of trust. Let me be crystal clear about this. Messy financials are way more than just a headache. To a potential buyer, they scream that your business is undisciplined. If your numbers are a disaster, they're going to assume the rest of your company is too. And that forces them to guess. And when buyers have to guess, they always guess low. That can kill a deal before it even gets off the ground. Okay, let's get practical. I want to walk you through a super common and frankly really expensive mistake that so many founders make. This one example perfectly shows the difference between a business that looks amateur and one that looks like a premium professional asset ready for acquisition. You gotta know this term, accrual accounting. The entire M&A world, every serious buyer runs on this one principle. It's the gold standard, and it gives the true picture of how your company is performing over time. It's not about when the cash hits your bank account. It's about when you actually earn it by delivering the service. Just look at the difference here. It's night and day. Let's say you land a huge $240,000 annual contract in June. On the left, with cash accounting, you get this massive, lumpy spike in June, but then the other months look like you're barely surviving. It looks erratic, risky. Now look at the right. Using accrual, you recognize $20,000 each month. Smooth, stable, predictable. Which one of these businesses would you rather buy? It's a no-brainer. And here's the part that blows most founders' minds. That cash you got up front, it's not really yours yet. It's technically a debt you owe your customer. It's a liability. You have an obligation to provide them a service for the next 12 months. And every month, you work off a little piece of that debt, moving it from a liability over to earned revenue. Getting this right is absolutely fundamental. Okay, so now we know how to record revenue the right way. Now we've got to talk about the what. Because in the eyes of a buyer, a dollar is definitely not always a dollar. The type of revenue you're generating has a massive impact on your final price. I mean, check this out. The difference in value is absolutely staggering. $1 million in one-time project-based work, that might get you a $2 million valuation. But that same $1 million in predictable recurring subscription revenue, that could be worth $8 million, maybe even more. Why? Because recurring revenue proves your business is stable and has predictable cash flow. And that's exactly what a buyer is buying, the future. But wait, it gets even better. We can actually take this a level deeper. Just separating your recurring revenue is a great start, but the real pros know there's another layer to this onion. There's a true gold standard of recurring revenue that gets the absolute highest valuations. And here it is, the revenue quality hierarchy. High-margin SaaS revenue is king. It's the golden goose. Why? Because it's scalable. You can go from $1 million to $10 million in revenue without having to hire 10 times more people. The cost to add one more customer is tiny. On the other hand, low-margin services revenue scales linearly. To make more money, you have to hire more people. It's still valuable, for sure, but a buyer just can't grow it as quickly or as profitably. All right, we've nailed the top line, revenue. Now let's pull back the curtain on the bottom line. This is where we get into how buyers calculate the number that actually determines what they're willing to pay for your company. So here's something most founders don't realize. Buyers pretty much ignore that net income number at the bottom of your P&L. They know it's just a starting point. They use a special process to normalize your earnings to find the real ongoing cash flow they can expect to see once they take over. They use these two fancy-sounding terms, SDE, which stands for Seller's Discretionary Earnings, or Adjusted EBITDA. But don't let the jargon scare you. The whole point is just to add back expenses that are unique to you as the owner or that were one-time costs to show the true underlying earning power of the business itself. And the best part, these add backs are totally legit and completely expected in any deal. We're talking about your owner's salary, any personal perks you run through the business like a car or travel, any big one-time costs like a lawsuit, and even some non-cash charges. Every single dollar you can document and defend as an add back literally gets multiplied and added to your final valuation. And the math here is actually pretty straightforward. A buyer starts with your net income, then they add back your salary and all those perks, then they add back any of those proven one-time costs. What you're left with is the true normalized cash flow, the number they're actually going to use to value your company. And this is what it all builds up to, the final formula. It's that normalized profit number, your SDE or adjusted EBITDA, times whatever the market multiple is for your industry. So our job as founders is to make that profit number as high and as provable as humanly possible. Okay, let's wrap this up and bring it all home. Mastering these ideas isn't really just about accounting. It's about a strategic shift in how you build your business so that it becomes fundamentally more valuable and way more sellable. Look, if you walk away with just one thing, let it be this. Doing your revenue recognition properly proves to a buyer that you are trustworthy. Focusing on recurring revenue proves your business is stable. And prioritizing high-margin revenue proves you are scalable. Trustworthy, stable, scalable. Those are the three pillars of a premium valuation. At the end of the day, it's all about a mindset shift. You're not just running a company day to day. You are consciously building an asset, a clean, predictable, high-quality, low-risk investment that a buyer will be excited and confident to acquire and that they'll be willing to pay a premium to own. So I want to leave you with one final question to chew on tonight. Go take a look at your own P&L. Is it just a boring report art of what happened last month? Or is it telling the most valuable, most compelling story possible about the incredible business that you've poured your life into building? The answer to that question could be worth millions.